Well, things started out great this morning. We had a nice little follow-through rally to Friday's post-jobs report euphoria. I think it was mainly a post 10-year yield move euphoria in response to the jobs report headlines. The 10-year note was trading, but of course, we break down the late day decline that we had for pretty much the rest of the day today. Once we hit about noon Eastern. So I'm going to talk about that significance. Again, just what some of the bullish signals we're seeing, how significant they are, how likely we are to maintain this bullishness. Obviously, we have a big event risk coming up here on Thursday. We've seen a bullish move into these kind of reports before. So, of course, we'll talk about that kind of stuff. There's some interesting moves in different asset classes, and the sector rotation today was different than what we've seen and during these other previous bullish moves. We'll talk about that. Some of the main headline stocks that are making some bigger moves today. And then we'll talk about our trade idea in an area that's not really discussed too much. A different part of the retail area that had a bigger move, and we'll talk about how to trade it. So let's go ahead and get started. Today is Monday, January the 9th, 2023. This is the Market Outlook from MarketScholars.com. My name is David Settle. All right, before we get started, I invite you to subscribe to our YouTube channel with this icon here, or hit the red subscribe button down there. Click the thumbs up icon to like our video. Comment on anything that stood out to you today. Join our website at MarketScholars.com for free. Follow me on Twitter for more content between the videos from day to day. And join our Market Outlook Facebook group that we've created. All right, if you're watching us here on our blog, check out some of these other things over here on the right. Come down to the bottom, click on this heart. It opens up this tab. Hit that like button. Same thing here with that thumbs up icon. Click on that. Hit that like button. Again, the more you do that, it helps get our content out to all of our followers. Almost hit 3 in a row with 100 likes, at least 100 likes. So I appreciate that. And again, the more you do that, the more views we get because of how their algorithms work, and that's why we always keep asking for it, and why we appreciate everybody that does it day after day. And remember, you can do that even right now while you're watching right here on our Market Outlook page. All right, let's start off taking a look at the S&P 500 here with the market forecast indicator. Again, we had a really good start to the day today. The near-term line had made it well into the reversal zone. The momentum line was up. We were above the moving average. I can't remember. We weren't that far enough above the moving average, but still we were up enough to get a yellow line. We actually got a bear tag. The bear tags usually start these. They either one time they have marked a peak and we've rolled back down, or they've marked every single rally to the upside. So we had some good opportunity here. But remember, the momentum line did not get to extreme levels. So if the near-term line does, we've seen that happen before, and it doesn't hold, right? That usually signals the end of a bullish run, intermediate run. We haven't even really started this intermediate run, but keep that in mind that the momentum line has not gone up there, so you would not expect the near-term line to go up there. So you'd actually expect, depending upon what the momentum line does tomorrow, the near-term line to follow suit. If it falls back down, then that would be another pretty bearish peak for the near-term line without getting in the reversal zone. And without this getting up above, 0, much less 2.5%. The intermediate line is rising, but it's not it's still in bearish territory, even though it's out of the reversal zone. The market sentiment line is rising, but it's not in bullish territory yet. It's still hovering there. When you look at some of the other indexes, like the Dow looks very similar. Again, the momentum line tried to get up there. In fact, it did get up above 90 briefly. The near-term line is in bullish territory, but it got the bear tag on Friday, and now is not following through with it so far. We'll see what ends up happening with that. We never did get the bear tag. Well, actually, over here, this is where you got the one bear tag that failed. All the others led to bullish runs. Looking at the NASDAQ 100, you can see it did not get a bear tag here. It's still below the moving average, easily 2% below. Again, momentum line, near-term line are in bullish levels, but not extreme levels that would suggest it will stay up here for a while. A little bit of a long upper shadow there. And then finally, your Russell 2000, which again, also sitting right at the moving average. A little bit below, that's why it's not yellow. And again, the momentum line, the near-term line look almost exactly the same. So short-term sentiment is bullish, but it's not bullish enough that you would expect to sustain a new intermediate run here. The intermediate line's rising, but it's still in bearish territory. So it looks really good, but there's also looks like we might be headed towards the moving average and then failing at the moving average. We've seen that before, especially again, this time was kind of close to the beginning. Not really. There's been other instances where it's been a little bit closer to the beginning of a bearish intermediate run and we fail, like we did there, like we did over here. And we'll see if that ends up being the case again. Again, sitting right at the moving average on the Russell 2000. Now let's take a look at some of the other indicators. Let's start off with the 3 green arrow chart. And you notice we had 3 green arrows in the Dow. We're right back to red, but we're not. We got 2 greens across the board. We're just below the moving average on all these different indexes. It's the only red arrow we got. So keep that in mind. We're close to 3 green arrows everywhere. This depends on whether we finish above the moving average. When you look at the weekly chart here, the weekly crossover chart, again, we got the higher close, and as of right now, this would be a reversal candle. That would be our transition candle with the green arrow, no less, rising PPO. And now we have a reversal candle because we're closing above the body. The week's not over with, but so far, it's a really, really good sign for that candle. Looking at the 3 green arrows split out, here we are at not only the 30-day moving average, but also the 50. Remember, the point of control is also above here, as well as the 200-day. So we're not out of the woods here. The MACD is above its moving average. We are above the 17-day. We got above the 17-day clearly on Friday, but when there's a gap between the 17 and the 30, if you don't cross both lines, you just fill it in. And so far, that's what we've done. We've just filled in the gap between the 17 and the 30-day moving averages. Again, we kind of seen that before, right? Over here, we filled in between the 30 and the 50, and over here, you filled in the gap between the 17 and the 30. That's on the downside, you filled in the gap between the 17 and the 30 there. And you did it again over here. So when there's a gap to fill, then we just typically fill it in unless you close above both lines at the same time. And obviously that's not the case right now. Looking at the Qs, which remember is a little bit weaker, it's the same thing, right? The 30-day is now crossing below the 50, and you got that long upper shadow. Basically, the shadow itself is filling in the gap, and that's it. And again, the point of control is above, so you got major resistance above where you're at right now. And the Nasdaq's still below that 23% retracement of that last intermediate rally. The S&P, you'll notice, never did get below the 23%. It was flirting with getting below the 38, as well as multiple moving or Fibonacci levels around this 3,800 level. We're actually still above that. So we're still, kind of in between major support at all these Fibonacci levels and some pretty significant resistance at other Fibonacci levels, as well as the point of control and the 200-day moving average. So this level between 4,000, 39, whatever, 3,900, 3,980, 3,975, but really 4,000 and 3,800, you've got that's a significant resistance on the top side, significant support on the bottom side there. Looking at some of the other oscillators, you can see the DMI. The negative indicator is dipped towards 20, hasn't dipped below it yet, but it is below 25, and the positive indicator is back above 25, and you got the bullish crossover there. ADX is really low, so we're not breaking out, but that's a pretty decent sign, pretty bullish indicator. You're not above the cloud, you're still below the blue line. What little weak bearish trend you had is gone. It's not completely. We didn't get zero. But we're below the -1 or above the -1 level. We're below 50, so that suggests that we don't have we're so weak in the bearish trend that it doesn't even measure as a weak trend. And like I said, in the cloud, it's not really helping there either. The Qs are actually still below the cloud, and you actually still do have a weak bearish trend on the Qs. Let's look at the RSI and the CCI, trying to get into bullish territory. The CCI really broke out up to positive 200 because of that really strong high point there. So a big time move in the CCI to help really solidify the move in the upper half of the chart. So we'll see if the RSI follows through with that. I mean, This is the first time in the last 52 weeks that we've crossed above 200. Now, there's been times that, like over here, we got above 150 on a pretty significant 3-day rally, but the RSI barely got above 50, and it never did get above 60, and you see what ended up happening, right? So here, let me just edit this, and we'll go all the way out to here, just keep going. Move this out here. There you can see the bearish trend. It's pretty much still there because we can't get above 60 and stay there, right? We kind of started to there, but we really couldn't get significantly above 150 and stay there and really solidify the bullishness, all right? And we're kind of seeing that again right now. Let's look at some of these other oscillators. The McClellan oscillator is looking great, up above 50 for the second consecutive day. The summation index is crossed back above 0. I mean, that's about as good as that can be. The money flow is back up above 50 at 55. That's actually a pretty good sign. Even if the money flow is not necessarily looking very strong, at least you got the money flow index into bullish territory there. Again, just slightly, of course. Your stochastics is above its moving average. It's still in bearish territory. So it's not necessarily breaking out here, but at least it's above its moving average on there. And the hull, you can see you flip the parabolic SARS on Friday. You got the green line on the hull, and you got the strong bullish candle. The MACD is up above its moving average and rising over here. So lots of good bullish signals here occurring. The Bollinger Band's bandwidth is falling. We are in the upper half, but we're not in the upper quartile. You can see the strong resistance above us, and you can see now the bands are actually switching back inside. So we got red dots that could signal a change in momentum again, from just like we saw before, from bullish to bearish. Now we'd be looking from bearish to bullish. The one thing that kind of stands out here on the intraday chart is we did get a higher high and a higher low, but we closed back below yesterday's high, which is Friday's high, as well as last week's high, because that was also Friday's high. So as bullish as we started the day, getting up above the midpoint of the 4-week range and trying to get into this gap up here, as bullish as we were, it didn't hold, right? And we came back down and filled in this morning's gap, and now we'll see how we follow through with this going into a new day tomorrow. Of course, everybody's got their eyes pointed on the CPI report on Thursday, and you can see from the Arun indicator, like we haven't got a new high, we haven't got a new low, we never did get a real significant expansion of the range. That expansion of the range might actually come from a bullish breakout, considering that both of these are the red line's down below 70. Once this hits 0, then you're susceptible to a bullish bounce that might take this up to the upside in a bullish direction, right? Usually the bullish ranges don't get as big as the bearish ranges do. As you can see right here is our main bullish range, and it got above 10%, but not very much. We had another bullish range over here, and it didn't get very high. And then this bullish range, of course, didn't get very high either. But you can get above 10%, and that might be what actually gets us through that level. Let's look at the volatility. Volatility continues to show an interesting pattern. The VIX rallied, not surprising, after closing at a low. In fact, the VVIX closed at like a 9-year low point on Friday, and of course it's starting to rally. The relationship between the two is negative, or is really weakly positive. For that, considering how strongly positive this normally is, that pretty much can be negative. And generally, when those two things move up together, you can see that when this relationship moves back up to the top, they generally go up together, both of the indexes. Looking at the other thing that stands out to me about the VIX is this is a seasonally bullish time of year for the VIX, right? And that's the last 5 years, of course, going to be influenced by last year, especially if I were to zoom out to 20 years, you still get a really strong move right now on volatility. Here into pretty much March expiration, options expiration. So this is a time of year where volatility generally ramps up, and with the VVIX as low as it is and the correlation set to go positive, and also if you look at the correlation of the VIX to the S&P over the last 20 days. The default set at 10 days, but if you switch it to 20 days, you can see the correlation is again uniquely positive. It's not very common for it to be positive, right? And you can see it's above zero, and generally speaking, when it's positive, it starts to ramp up, right? That correlation will correct itself to the upside. So you got this positive correlation with the S&P, seasonality, as well as a weak positive correlation with the VVIX that is historically low. That's all set for a rise in volatility going forward from here. So keep that in mind whenever you're considering your intermediate posture, how bullish or bearish we may be. We're going into an intermediate move with a VIX that's poised to make have a tsunami move, in this case to the upside, a significant move to the upside here. And that doesn't even count, again, the VVIX kind of measures the compression, but we've been talking about for a long time the compression in the VIX, measured by the ADX. I mean, being below, we talked about this before, being below 10%, so uncommon, unless we're in a very, very low volatility environment. We're not only not in a low volatility environment, but we're above 20. So we got significant compression on the VIX, also set up for a move to the upside in volatility. All right, now let's take a look at how these different asset classes performed today. And you can see the biggest mover today was the dollar dropping. At the beginning of the day, the dollar was down, yields were down, commodities were up, but that didn't really hamper anything. Remember, that was the triumvirate for most of last year. The dollar being up, bonds being down, and commodities being up, with yields higher. But yields actually fell throughout the day, so bonds were higher. The dollar stayed down throughout the day, and then commodities stayed higher. Stocks started off really strong. Qs were up over 2% at one point, nearing 2.25%, before coming down and finishing with a less than 1% gain. Small cap stocks were less than 0.25%. The S&P was down on the day, including the Dow being down on the day. So big reversal in price. The weakness in the dollar still lifting international stocks higher. You can see what this weakness in the dollar looks like here on its own chart. Kind of breaking down below a lot of lows here today and trying to get below this volume node. You can see the MACD and stochastics have been up. They appear to be trying to roll over. If you look at its market forecast chart, you can see that we got another cluster on today after getting this yellow line, but not quite the light green shading, which is you'd have to get it above 20. So it's still in the reversal zone. So you still got quite a few clusters. It's been a while since the dollar's had a cluster of clusters back during this bullish, bearish run over here in post-COVID and early 2021. It's a very similar period in early 2021 when these industrials and financials and those kinds of stocks all did really well. The dollar dropping in a similar fashion. You can see the Fibonacci line I've got drawn here is based off of, a much longer term. You see it goes back out the 10 years. It goes out to, I think it goes out here. Where does it go? Where does this one go out to? To the low point, 2011. So a really, really long term. So not quite the bear market low point of 2009 that stocks are coming off of, but this kind of credit crisis low point that preceded that. You can see this is a weekly chart, mind you, but the weekly chart, and it's not over with, it's only a day into it, but you got dark pink shading and a red line, and you got a cluster. You got your first cluster today. So it's not too common to cluster right at the very beginning of a not too common to get a cluster right at the beginning of dark pink shading and a red line. You got one kind of close over here in 2017. You can see some other instances that are again kind of close. This one I guess would be the closest in 2010, and you continue to continue lower here. But it goes to show just how strongly higher we were when we got this overbought cluster that we finished the year with, or at least had in the fall. And we're working our way down now 4% below the 30-week moving average. So showing some pretty significant moves. You can see on the DMI, the dollar index is still like the ADX is still very high. It's above 30, still barely, but above 30. You did get a pop back up above 35 on the negative indicator. Not quite back below 20 though on the positive indicator. We've already had our surge of momentum, right? When you look at the MACD here, remember the histogram's already bottomed. Excuse me. Let's go here. The histogram's already bottomed, and the MACD appears to be bottoming. So I wouldn't put a whole lot of downside momentum into any dollar moves. It seems to be triggered mostly by what's going on with the 10-year yield. The 10-year yield is down quite a bit in the last few days. In fact, when you look at it on this chart, this is all in response to the jobs report, and the 10-year yield is kind of in a program move to the downside based off the headlines. Remember, the overnight Fed funds rate's at 4.5%, and they're expected by 100% odds in the futures market at least to raise rates to 475 basis points. And the 10-year note's dropping. The 10-year three-month spread has dropped down to really, really low levels. This is, the lowest level on record for this spread that it's had on, at least using the Fed's records here. You can see the 3-month is still moving higher, and in anticipation of the Fed raising rates to 4.75% here in February. That's widely expected, 100% odds of that happening. The 2-year note, however, is pretty much saying that that's not going to happen. That it's going to stay at 4.25%, 4.5%. The 2-year note is actually down below the levels of raising rates. This is what prices in what the Fed's going to do. This is the current kind of effective Fed funds rate, kind of matches the current Fed funds effective rate. The 10-year note again at 3.5%, obviously down to 3.5% is it's significant moves to the downside here. It's causing this last little batch of stock strength and dollar weakness. But the question is, how likely is this 10-year note going to continue to move lower, and how likely is the long-term bonds going to break higher here? You would expect eventually long-term bonds will make a move to the upside as a safe haven asset class. It's been on this kind of convergence mode. Now we are, last week we finished above the 17-week moving average again, so we're kind of in this kind of bullish divergence, but you notice we're not above that 30-week moving average yet. We're not above this 23% retracement yet of this decline that bonds have been on for most of this is a bear market decline for bonds. It usually leads the stock market to whatever it's going to do. Obviously, 2021 was a correction and a failed correction bounce. Very similar to what stocks saw in 2022. So, is this a kind of bear market move that stocks are going to see going into this year that bonds have already seen? That's the idea, especially if bonds start to rally here at some point, which obviously would mean yields are falling, which typically means the Fed is cutting rates. Problem is, I don't see the Fed cutting rates anytime soon, and so the market's going to have to live with higher rates. At some point in time, this spread's going to go back to zero, and when it does go back to zero, as you can see, it's going to go back to zero, and every time it goes back to zero, there's a recession associated with that. One of two things is going to happen. Either the Fed's going to cut rates and make it go back to zero and up and higher, or which is what happened on all these other times, or the 10-year note's going to rise, and that's only going to rise because of rising inflation expectations, which again puts us right back in this whole problem that we've been in since March of 2021. So you can kind of see how it's not necessarily the best thing that this keeps dropping to such extreme lows, because the lower it goes, the faster it's going to rise, and the more painful it's going to be when it does. Let's look at the sector moves here for today. Let's go out here to the comparison chart and just look at today alone. You can see, again, we had technology, consumer discretionary communication services leading the way early, along with materials. By the end of the day, they were still there, but utilities kind of matched them along with materials. Technology up about double what these other sectors are. On the downside, staples were down, healthcare was down, industrials, financials, energy were down. So this kind of cyclical area that's been so bullish is kind of rotating a little bit here out of favor. When you look at the 12 grid for the different sectors, you can see the cyclical sectors up here at the top. Not quite. This communication service looks the best. These here in the middle, at least above their moving averages, but all light green shading and a yellow line so far, except for financials. And then you can see your safety trades here are all kind of flat. So a mixed picture. We don't quite have the dark green shading and green line across the board that you would like to see, especially coming off a correction low point where everything goes up together, because everything typically falls together during the correction. All right, now let's take a look at some of the individual names in these areas. XLK did really, really well. As you can see, a lot of green up here and some consumer discretionary. Amazon, Apple was up 0.5%, Microsoft up 1%. Semiconductors, you can see Taiwan Semiconductor doing really well. Starting to, getting that bear tag that, has again potential of being the start of a bullish run as these other bear tags were. Some of these bear tags, so again, you can see not necessarily the start of the runs. So you have to kind of pay attention how we follow through with this. You could see some of these Chinese stocks again. Some of them, Alibaba especially, doing the best. Alibaba has been on fire lately. It's really kind of going parabolic. When you look at its DMI here, you can see how its positive directional index is above 40. The negative now is below 10. The ADX is just shot like a rocket ship to the upside. When you look at its Bollinger Bands and the Keltner channel here, Alibaba, you can see how it's been, well above the upper Bollinger Band. The Bollinger Band width is spiking up to the upside. It's lagging, so I'm gonna venture to guess this thing's gonna break that 150-day mark, move to the upside, which typically, again, kind of sets a limit. Not that it can't go up, obviously, from because stocks can do anything, right? But it starts to kind of show how much it's losing momentum. It's at, the momentum, MACD is at its highest level that it's been in the past year. Momentum can be, momentum continue to run, so I wouldn't necessarily say, hey, let's sell this because it doesn't have anything left in the tank. You saw Tesla had been so bearish, got that engulfing pattern on Friday, now above the 8-day moving average, the MACD crossing above its moving average, stochastics turning higher. You saw its Bollinger Bands and Keltner channels, its Bollinger Band width is highest point it's been at for, who knows how long, at least, the last 5 years is the highest Bollinger Band width the last 5 years. The last time we had this high of a band, at least similar bandwidth peak, was on that rally up to 400. So moving our way down to 100, and being below the Keltner channel for this whole time, now finally getting up above the Keltner channel. Appears that we might be peaking in the negative momentum, so that it might be finally starting to turn up a little bit here. You can see the positive index was down below 10. The negative was well up above 40. So the ADX really peaking above 45 in very, very high levels. So it opens up the possibility of doing a kind of a bullish trade when you look at like selling a put on this. If you look at the 195 put, you need to get $1.16, so you're pretty close to getting $1.16 to get a 30% return on risk is kind of what we shoot for. So that's something that you can say, okay, let's do like $1.20 as a stop limit order, so that now it has to drop some before we get filled in. on this trade, and considering kind of where we're at, like the range that this trades in, trading in $6 range here today, that's easily attainable in an intraday range. So we can put something like that on there. If you notice, that's going to be about a $380 risk. So I would do a couple contracts here because of the earnings risk that will be coming up on the stocks like Tesla, the other FANG stock names. We'll just stick that here into our market outlook category, and you can see some other stocks that have been not so good. You can see in the healthcare sector, you've got like Pfizer and Merck and Eli Lilly all struggling, and you can see, look at the drop there in Pfizer and Merck getting a big engulfing pattern, and Eli Lilly really breaking down hard more than the rest. If you look at like its moving averages here, you can see it's starting to fill in a pretty significant gap here down to the moving average. This is something we've done a bearish trade on in class, and you see it. And today was a really good day for that. And like I said, Pfizer would be another stock that kind of fits that same category, breaking the 200-day moving average. MACD is negative. You can see from a weekly standpoint, you're breaking the 17-week moving average of the MACD rolling over. So you have some opportunities for some downside on a stock like that. The trade that we decided to do on our Market Outlook live video today was on Dollar General. If you take a look at Dollar General, here, let's go look at its chart first. You can see, again, looking at the weekly chart, big breakdown today as well. We have been in convergence mode for such a long time and flirting with getting below and back above the 17-week moving average as the MACD has been dropping. There's a huge gap here between the 50 and the 200 for the last so many years. We've had a huge gap there. If you take a look at today's move on the daily chart, you broke below the point of control. You broke below multiple moving averages, the 17, 30, 8 and 200-day moving averages, while failing at the 50 on Friday. MACD breaking below its moving average, stochastics rolling over already below its moving average, getting out of bearish territory. You can see its market forecast chart has turned dark pink shading in a red line, is falling down, the momentum line falling down to low levels on the Ichimoku cloud. We are below the cloud. It's been so sideways. We had a bullish trend going that's not there anymore. Looking at the Bollinger Bands and the Keltner channels, the Bollinger Bandwidth got really small. In fact, it broke the lowest levels in the last 150 days, and way inside of its Keltner channels. It is so set up for a breakout type move. And today it is negative. The bandwidth is, or percent B, is negative, which means it closed below the lowest band. So what we decided to do is say, okay, let's go out a little bit long term. Not that I have to hold it out to May, but it keeps the extrinsic value, from fall. The theta is relatively low, so we don't have to worry about the extrinsic value falling nearly as much. But we bought the at the money put a 50% stop order on that one with one contract to see how long, if this makes a move to the downside and starts to break out with this pattern that we saw today below these moving averages, then we can kind of ride this for a while, and we don't have to worry about necessarily time eating away or eroding that extrinsic value, at least not for the next little while. And if this never kind of breaks out, instead maybe breaks out to the upside, then we can like usual take a small loss and just move on to something else. Alright, well that does it for tonight. You've heard from me now. Now I want to hear from you. Use that link popping out in the top right corner of your screen that takes you to our Market Outlook forums. Open up any new thread with any questions or comments you have. Reply to anybody else's thread, and let's keep this conversation going in between the videos. Again, thank you very much for watching. Remember to subscribe to our YouTube channel. Hit that thumbs up icon. Comment on the video. Like us on Twitter and Facebook as well. And join our website at marketscholars.com for free. Have a great rest of your Monday night, everybody, and we'll see you all next time.